Welcome back. After a year of economic uncertainty, there may be some encouraging signs on Wall Street that recovery is starting to find its footing. Morgan Stanley says 2026 won't be a boom or a bust, and a broader, more balanced expansion may already be underway. We're joined live now by George Noceti, wealth advisor with Morgan Stanley. Good afternoon to you.
Stephanie, how are you? Happy New Year.
Yes. Happy New Year to you as well. Thank you so much. Well, George, Morgan Stanley says the economy turned a corner in 2025. What signs tell you that this recovery is real and not just a temporary rebound, especially given ongoing concerns over affordability?
Well, Stephanie, the U.S. economy is really moving out of a multi-year rolling slowdown. Even though the stock market has done well, the gross domestic product, the economy has really slowed down. And that's because we've been so focused on tech. Tech has really led the way. And now we're going to have more balanced growth we're expecting, which already happened in 2025. And in 2026, we really expect financials, industrials, healthcare, and consumer discretionary to lead the way above tech.
Okay.
And so we think that will really help. Plus, the Federal Reserve is more likely to be supportive. Will tend to lower the rates. You know, when inflation was extremely high, they were at 5%. Their job was to cool the economy down. Economy's slowing, so now the lending rate to banks is 3.25. With the change in the Federal Reserve chief in 2026, we'd probably see the lending rate to banks go down. That will help all businesses. And the other key thing, Stephanie, is that economies are kind of pushed when you stimulate them by adding funds in, but that's not a really true economy. Our economy is going to grow because of companies' earnings and their productivity. We see those rising. All the reports, all the numerical information we've looked at have all been positive.
Now, data that you've also shared with us suggests that unemployment is sitting near record highs. Does that signal any problems as we head into the new year?
Well, the unemployment rate is still, we pretty much have full employment. We're hearing little pings of layoffs here and there. The federal government added a lot to that with DOGE and tremendous layoffs in the federal government. That's why our unemployment rate ticked up a little bit last month. But basically, because we're going to be broadening the economy into financial jobs, healthcare jobs, industrial jobs, companies that serve consumer discretionary buying, that's going to broaden the base and will make the unemployment stable. Not really grow it very much because we've limited immigration now, but I don't think we're going to see great job losses.
Okay, so given that, does that change anything in terms of how investors should be thinking about the markets and long-term strategy for next year, the unemployment rate?
Right. Well, okay. So it's really important that consumers really answer three questions, and that would give them confidence. First question is, will taxes be lower in 2026 for businesses? That's a baked in yes, because the new tax act that the president passed will give businesses a big break. This will increase their profitability. Second thing is, we have to find out, will the Federal Reserve lower the interest rates? If and when they do that, that's going to help smaller companies get funding to really grow their businesses. It's likely that that's going to happen. The third variable that the jury's still out right now is artificial intelligence. If you think artificial intelligence is in the second or third inning, then it's going to really create productivity and really grow businesses. At Morgan Stanley, we think it is, and that's why we think, just as an example, we believe that the S&P 500 will be up over 1,000 points at the end of next year. Now, we're in the middle of the pack. The other investment banking firms, many of them are higher, some of them are lower. We're kind of in the middle there. So we're very euphoric about it because we see all sectors of the economy really growing. It's not just going to be focused on tech, which excludes hiring. You have to be technologically astute in order to get a job in a tech firm, whereas now you get jobs in banking and a lot of the other areas we see going on.
Okay. Now, a lot of viewers are understandably focused on interest rates as well, and you touched on this a bit earlier, but how supportive do you expect the Federal Reserve to be on this going into 2026? Could you expand on that?
Well, Jay Powell has been very rigid and conservative on the inflation rate. His job really is to keep inflation down, and he's brought it down from 7 or 8% down to arguably about 3%. He's also concerned about unemployment. So unemployment's okay right now, but the interest rates are really slowing the economy down. So he's getting pressure to lower those rates. It probably won't happen in January, but we'd probably see another discount off the 3.25% lending to banks probably happen after that. Now, when the Federal Reserve has a seat change and the new director comes in, appointed by the president, it's likely that that will push the lending rates down. That doesn't affect the mortgage rates for people that are looking for homes. There's a whole different model affecting that. This is really the banking rates for credit cards, for car loans, for businesses getting business loans to grow their business.
Okay.
We don't think that the mortgage rates are going to come down very quick. We could see a trend slightly below 6%, but the nostalgic days of 3 and 4% are really over for a longer period of time.
Some interesting food for thought there. Thank you. Given that, how should families be thinking about spending and saving as they head into the new year?
Yeah, very, very good question. So it's really important that consumers recognize the changes in the economy to the positive that we've just mentioned. So when they're investing in the stock market, they should be diversified. And people don't necessarily follow those rules. They invest in the hot dot, in tech, or just in the U.S. If consumers would have invested a portion of their portfolio in Europe this year, Europe outperformed the U.S. stock market by about 20 to 30%. So that would have helped a lot on the downside in the beginning of the year. So diversification, still be invested in tech, very important, but diversify into financials, banking, and manufacturing, and a lot of the other areas that are really poised for growth right now. So diversification is really, really important.
Okay, a key word there. And what would you say are some of the biggest risks that you're forecasting that could potentially knock things off track in 2026?
Yeah, so nothing is promised, right? This is speculation, especially people like me that are talking about this in the beginning of the year. But there's things that can happen in the economy. We could lower the interest rates so low that it overstimulates the economy. And we could have higher inflation. What we have to be careful of is runaway inflation. That could possibly happen. Artificial intelligence, which we see a lot of data now, is really showing how it is very, very productive and really helping profitability in companies. If we're wrong, that could really upset the market. So you have these headwinds out there. Nothing is guaranteed. That's why it's really important, to be diversified and not to try to play the thing you think is really hot right now. Usually, when you think it's hot, it's not. Those stocks, even the tech stocks. If you remember back in April 2nd, when the president announced the tariffs, the market tanked. I mean, tech was down, NASDAQ was down 22%. So it takes a lot to recover. You got to come back 40% in tech in order to recover.
Right.
So if you're diversified, you're going to have some money in things that are doing well, some money that is not doing well. And so you have to consider your age, your risk tolerance. And if you're going to buy Bitcoin, I mean, great, it is an asset class. But it should be a small portion of the portfolio, and even commodities. Those are all hedges. But you have to be a very wealthy investor to be able to start the speculation part.
Okay. And last question here for you. If there was one New Year's resolution that you'd advise people stick to when it comes to their finances, investing, what would it be?
Stay the course. Don't sell low and buy high. This is what happens. If you can remember back to COVID, back to 2008, when the market tanked, people that got out, they baked in a loss. Then they tried to get back in when the market hockey sticked up, and they paid more money. You can never get ahead that way. If you're diversified, you have to stay the course. I mean, you have to do good planning and good research, but you have to have the stomach for it. It's the market. It can be volatile. And we all, take the stairs up in our portfolios. It's a long climb. And when we're wrong, we take the elevator down. So, be conservative and have the stomach to stay in there even when you see volatility.
All right, George Noceti, Wealth Advisor with Morgan Stanley. Thank you so much for your time today. And again, a very happy new year to you.
Well, you too, Stephanie. Thank you very much.
Thanks very much.
Yeah.